hello, good evening to everyone. Thank you for giving up some time to be with us this evening. My name is Louise. I'm a partner at Larking Gowen Accountants, and I'm pleased to be hosting this webinar tonight alongside Ascot Lloyd Financial Advisors. And speaking today, we have Penny Speller from Ascot Lloyd. So Penny is a mum of two rather grown-up children and lives with her husband in Colchester. She started her career, hope she doesn't mind me saying, in the early 80s with Prudential before setting up her own IFA business back in 2004. And her client base mainly consists of teachers, doctors and state sector employees. Then in 2012, Penny became part of Ascot Lloyd, and the rest, they say, is history. So this evening, Penny will be running through some of the main considerations that should be taken into account when looking at retiring, and specifically if you are looking to go earlier than your normal retirement age. We will have a Q&A session at the end of Penny's presentation. So hopefully you can all see the question box on your panel. So please do pop any questions in there as we go through. You have my contact details and Penny's contact details on screen. So please do take a note of those for anything that you may think of at a later date. Please do get in touch with either of us and we'd be glad to help you where we can. So without further ado, I will hand over to Penny.
Thank you, Louise, and good evening, everyone. And I thought it might be useful to run a session, and Larking Gowen have obviously been collaborators in this design of this webinar, to cover some of the basics of the scheme. So we'll go through that in detail. I am an independent financial advisor, which I think is really important to know and understand. So independent advice, I think, is invaluable, as is a good accountant, as with Larking Gowen. I've been in financial services all my life. I have two grown-up children. My husband is in financial services. And so it's been part of our lifeblood for a very long time. And it's something that I've been very lucky and enjoyed throughout my career as well. So I have current live clients. I still advise. And some of my clients are NHS members and doctors, and some are local authority workers and in the superannuation scheme. So over years and over time, my knowledge has developed and evolved. So as I'd like to think, a good understanding of the local authority scheme and in particular the NHS Pension Scheme. So what we're going to do tonight is to look at the NHS Pension Scheme, but I thought a bit of retirement facts might be interesting to start with, as I'm sure it won't come as any surprise that the number of doctors retiring and retiring early has gone up considerably in the last 13 years. In fact, it's more than trebled in the last 13 years. In 2007-2008, there were 401 doctors who retired early, and the last tax year, 2020-21, there were 1,358 doctors that retired early. That's in England and Wales. And another interesting fact is the age at which doctors retire has got younger as well. So it used to be 61 as an average age for retiring, and now that's dropped to 59. So life as we know it, and I'm sure, again, this doesn't come as any surprise, is changing, and retirement and what retirement looks like is changing for many people as well. So on to the NHS Pension Scheme, where you probably know some of the basics here, and I've kept the presentation deliberately structured in that way to look at the basics of the scheme, the NHS scheme, and then we'll drill down into each section once we've just had a high-level look at each. And I'll show you one or two examples of the impact of retiring early from each element of the scheme and the sort of effect that that has on benefits at retirement and retiring a little bit early. So starting with the original scheme, the 1995 section. And this scheme has a retirement age of 60. And it may be that you've seen the abbreviation NRA, which stands for normal retirement age. 60 is the normal retirement age for this scheme. And it's split into two, the 1995 section. There's a final salary scheme element to it, and then which most officers and consultants, hospital consultants, are members of. And then the second element to the 1995 section is doctors, GPs, that section, which I think is the most complex element of the NHS pension scheme. It's a final salary scheme, and we can talk more about that in a moment once we drill down into that 1995 section. It's a final salary scheme, and the final salary is one of the components that goes towards determining the pension calculation come retirement. That together with service. So, and again, we'll talk a bit more about that as we move through the presentation. So in 2008, the 2008 section was introduced, and the government are now starting to look at morbidity rates and financing of the scheme in a bit more detail. And you can see they've pushed out that retirement age to 65. The difference between, or one of the differences between the 95 section and the 2008 section is the 1995 section will provide a pension income and tax-free cash. And that's the only section within the NHS pension schemes that does provide tax-free cash. And as you move into the 2008 or the 2015 sections, the pension drives the pension income at retirement. And let's put it this way, if you want to give up pension income, you can under something called commutation, which can then generate tax-free cash. And we'll talk a bit more about that as we look at each individual section. But we've pushed the retirement age out to 65 in the 2008 section. And then after something called the Hutton Review, and we could spend another hour talking about that, but this was another government instigated review where again the NHS pension scheme or local authority pension schemes were reviewed very thoroughly by Lord Hutton. And his paper, one of the recommendations in his paper was that the normal retirement age or the pensionable age for this element, the 2015 section, should be aligned with the state pension age. And that's a massive difference now. And certainly for younger doctors, with a retirement age or a state pension age of say 68, then NHS pension being linked to that is slightly scary, I'd suggest. So that's the main difference, that the state pension age and the retirement age for that element of the scheme are now aligned. So moving on, let's look at each individual scheme now in a bit more detail. So start with the 1995 section, the original scheme. And it may be that some members in the 1995 section have what's called a protected minimum pension age. And you may be aware, but it's worth asking the question or finding out if you do, because this will give you protected benefits come retirement, and there won't be an actuarial reduction. And I think that's the first time I've used that phrase, but the actuarial reduction of benefits will apply if you were to take your benefits before the normal retirement age of the scheme. With the 1995 section, you could retire with benefits as early as age 50 if you've got that protected minimum pension, or from 55 to 60 if you've got the MHO status. Then you could retire from 55 to 60 with no actuarial reduction. So it's a hugely important element, I think, of the scheme and understanding that protection within that scheme, that element of the scheme, the 1995 section, and just being aware of, does that apply to me or not? As an example, don't forget, this section of the scheme has a normal retirement age of 60. If you wanted to take benefits from this scheme at age 58, the benefits would be calculated and then reduced by 10%. The income would be reduced by 10%. And don't forget, this section has pension income and tax-free cash, and the tax-free cash element would be reduced as well, 6%. So 58 being the retirement age, 2 years early compared to the normal retirement age of 60. There's a bit of a 5% reduction, well, there is a 5% reduction for each year taken early, and then 3% off of the tax-free cash. So these actuarial reductions are really important to understand when planning retirement transition and that phase through life when work changes and something else takes over, or work becomes less, because retirement is incredibly flexible this day and age. Okay, so let's look at the next section, 2008. And remember, the normal retirement age within this scheme is now 65, 2008. You could still retire at age 55 up to age 65. And again, as an example, if you retired at 62, 3 years before the normal retirement age of 65, then you're looking at 15% reduction on income from the calculated pension benefits at 62. And don't forget, there's no tax-free cash with this scheme. So the reduced pension is calculated at 62, for example, and then that pension, you could choose to give up more of the pension income for tax-free cash if that was one of the needs or one of the achievements that you wanted to get out of this element of the scheme. But it would mean a reduction again, a further reduction, by commuting some of that pension in turn for tax-free cash. Okay, let's look at the 2015 section. Now this is slightly different again. Now remember, the normal retirement age for the 2015 section is state pension age. But again, you can retire at 55. There would be huge penalties or reductions, actuarial reductions, if you were to do so on the benefits accrued in this section. But again, as an example, if you retired at 64 and your state pension age is predicted or is established to be 68, then the scheme determines you're retiring 4 years early. So again, 5% reduction for those 4 years. You're looking at a 20% income reduction by taking benefits at 64 from this section of the NHS scheme. So really important elements to understand and be aware of, and how each section within the scheme is dealt with for retiring early is something that I've helped clients with and helped clients to understand and to plan for and to evaluate the best option for planning retirement. Okay, so moving on, I've mentioned reduced benefits for retiring early and the term actuarial reduction. So these are complex actuarially calculated tables that are within the NHS pension portal. Actually, you can see them explicitly, and the government actuaries will determine, based on morbidity data, what factors they use to reduce the pension by age. But it's a phrase that's worth understanding and knowing and just modelling for yourself to see, if I were to go perhaps a year earlier or a year later, the difference on income and on pension benefits that can make is an interesting exercise and one that I've done for clients. So it's worth being aware of. Okay, another example. Let's just look at another example from the 1995 section. So don't forget, the 1995 section has a normal retirement age of 60. And so if you were to retire at age 59 and you've accrued a pension up until that point of £48,000. And don't forget the 1995 section has tax-free cash. So there's a tax-free cash element of 144,000. The reduction on that explicit example of benefits at age 59 would be as follows. The pension's reduced to 45,840 and the lump sum's also reduced to 146,888. So that gives you a very explicit example, I think, of benefits lost by leaving the scheme a year early. I think it's an interesting point to think about and to model as well in anticipation of planning retirement is just a reduction in hours maybe and a reduction in salary maybe to continue working but just to work less, and the impact that might have on benefits at retirement. So instead of suffering the penalty or the reduction by retiring and taking benefits at 59, you work till 60, the normal retirement age within that section, but you work less if there's an option to do that, and the impact that would have on benefits as well. And sometimes it's not as derogatory as some people think. It's an interesting exercise to work through and to model before final retirement decisions are made. Okay, just moving on. As a financial planner, I think, I mean, as an example, I have a doctor who, several doctors in fact, who use Larking Gowen as their accountant and use Ascot Lloyd and myself as their financial planner. And I'd like to think the value add, or one of the real specific value adds to that planning process when thinking about retirement and specifically early retirement is something called cash flow modelling. And it does what it says. There's very sophisticated software available now that enables me to plan very specifically on how long investments would last in retirement when impacted by RPI and inflation and different years where spending is different, maybe dependent on children's ages and how much income you're going to give them to support them with getting onto the property ladder, for example. Or just answering simple questions like, how much do I need to live on in retirement? I get asked that a lot, actually, by clients. How much do you think I need to live on in retirement? And that's an exercise worth doing 5 years out of retirement, just identifying your essential spend and your luxury spend. And having that knowledge in your mind 4 or 5 years out of retirement, I think, is a really useful thing to do, just to start to have those conversations and think about those sorts of elements. And then if you've got investments, as many doctors and consultants do and NHS members do, it's how do those investments sit alongside my pension benefits, and how best to draw income from invested assets alongside pension assets. These are hugely complex decisions, and if dealt with tax efficiently, can not only make the investments last longer, but provide you with, obviously a lower tax bill as well, which is a nice thing to achieve. Can I afford to retire? So again, a very common question I get asked: how much do I need to live on? Can I afford to retire? And like a lot of things in life, the thought is often worse than the reality. There's obviously, well, let's say obviously, there's a retirement curve. And at the start of retirement, spending can be quite, not so much at the moment with the pandemic, but spending can be quite high and comparable to income spending when you were working. And then the bell curve disappears or lowers and reduces. And then what makes it go up again the other side is obviously long-term care. So these sorts of philosophical questions about retirement, I find myself helping my clients with. And then using cash flow modelling in a very sophisticated way, we can use objective data, projected pension income, existing investments and assets, and model longevity to those assets and income and efficiency, tax efficiency from those investments and income as well. And we've spoken at length already about the impact of taking benefits early, but establishing that for yourself individually, I think, is a really important exercise to go through, and one that you can start at any age. Maybe 5 years out of retirement or thoughts of retirement is a good place to start, and to look at the impact of taking benefits early. Okay, moving on. I thought it might be really useful just to think about some of the good disciplines that I find very helpful. I'm sure Larking Gowen would find really helpful as well with our lovely clients in terms of record keeping. The NHS Pension Scheme is as susceptible to human error as any pension scheme is, and anomalies at retirement date or 3 months before retirement are they're stressful and disconcerting. So I think that 5 years out of retirement is a good place to start. And some of the good disciplines of record keeping would be to keep year-end pay slips. And you may already do this, which is great, but keeping that year-end statement of salary earned, pensionable salary earned at the end of each tax year. So it's either a month 12 or a March payslip, which is the one that normally is the most important one to keep. Also understanding the payslip and the dynamics of gross income, pensionable income, not so much net income, but the difference between gross income and pensionable income. Because the pensionable income data will be fed into the NHS pension scheme and will ultimately go towards calculating pension benefits at retirement. So I think a simple exercise, if you're able to, is to go back 5 years, find that March payslip, identify from the payslip pensionable income for that tax year, and it's worth cross-referencing that. And I know for GPs, Louise will mention that a little bit later, but I know that for GPs this is not as simple an exercise as it is for hospital consultants and officers. So, but finding that end of tax year pensionable pay figure from your own documentation, and then calling the NHS pension scheme and cross-referencing it with what they hold as data is a very valuable exercise, especially if you've worked for multiple trusts or had multiple income streams. Then mistakes happen, and it's a very useful exercise and could go towards making a difference between final pension and the final pension calculation. So I think that's a good discipline, or one of the good disciplines I'd suggest that we do. The membership statement of service, I think, is also invaluable as well. And this forms the second element, if you like. That membership statement of service shows the history of your employment with the NHS, and you'll be best placed to know whether that looks right or not. And if there's any anomalies or periods or gaps missing, then again, phone up the NHS Pension Scheme and ask them to correct it. Find the pay slips that evidence that you were employed, and then that can be corrected. So it's the pensionable salary at the end of each tax year and the service history. Those two records are invaluable in determining correct pension calculations come the time. Louise, did you want to come in there about GPs? I mean, that's a difficult one, isn't it?
Yes, I did. Thanks, Penny. Yeah, I just wanted to, as Penny sort of alluded to, for the GPs, you won't have payslips at March each year. You will have a end of year pension certificate. So whether you are a salaried GP or a GP partner, you will have your respective certificates. So it's, I think what Penny's saying is just as important. You still have to check your pensionable pay each year. Now, I suppose the other slight difference for the GPs is your total reward statements should automatically give you a list of all of your pensionable pay each year from the time you became a practitioner. So you may not have to phone up NHS Pensions. It should all be listed out there for you. Now, I think, not to contradict Penny, but she's absolutely right that, you know, I think similar to what we tell our clients, you know, 5 years out of retirement is when you want to start thinking about the topics that we're talking about tonight. But I think record keeping is good practice from day one.
Yes.
I'm sure many of you on here will have, been hearing about annual allowance and the tax charges. So I think just having a good understanding of your pension position is really important from day one. And as Penny said at the very outset, having a financial advisor and an accountant who are joined up and both have that understanding of the pension scheme is really important, because that's an area that the accountant can help you with, checking your pensionable pay, checking your total reward statement, the membership service. So I just wanted to say it's slightly different for the GPs than for the hospital doctors.
Yeah, thank you, Louise. Thank you. That's really helpful. I mean, some of the common mistakes that I've come across are when doctors' pay goes down then up. Sometimes the input data can be wrong. If you've had an overseas break and missed membership, can be a problem. Added years calculations, that can sometimes be wrong. And sadly, with a number of doctors who've retired and retired early, some of those decisions to retire early have been influenced by, obviously, the tax charges that have come about the last couple of years. And I think taking action without advice, either from the accountant or from a professional advisor, I think that's one of the problems that's caused a lot of doctors retiring early, looking to retire early, have jumped out of the scheme without perhaps taking just a moment to step back and have a second opinion from a professional, and either accountant or a financial planner. I think is an invaluable exercise, and often it's not a costed exercise. It's an overview of the situation you're in with someone who is knowledgeable of the scheme. I think is an invaluable exercise before taking decisions such as benefits early or opting out of the scheme. So hopefully a good couple of points there on record keeping. It will be so worthwhile and make life, as you transition into retirement, hopefully a lot easier. So I hope that's helpful. I thought I'd talk about the McCloud Judgment and just talk a little bit about how the McCloud Judgment came about. I know there's an awful lot of information out there that you can source on the McCloud Judgment, but just in case, just to cover off the basics, the 2015 section of the NHS Pension Scheme offered what was called transitional protection to members who were 10 years away from their normal retirement age. So there was a transitional protection offered to some members. This was the premise of the McCloud Judgment, that a certain category of scheme members were protected in a way that younger members weren't. So the McCloud Judgment came about by some quite young judges and firefighters taking the government to court, to the Court of Appeal, and saying they felt that the judgment, or certainly the protection, was unfair to those younger members of the scheme in terms of age discrimination. So that was the basics of the judgment and how the McCloud Judgment has come about. And the Court of Appeal ruled in favour of the judges and the firefighters and said, yes, it is discriminatory in terms of age. So the conclusion of that, and there's obviously a lot more to it, that I could offer you a lot more information if you wanted, but the conclusion is that come the point of retirement, when you choose to retire, you will be given the best possible position in terms of pensionable salary, service, to calculate pension benefits, and there'll be no discrimination involved. Everyone will have that opportunity to make that choice at retirement, not just those that were deemed to be 10 years away from retirement. So in terms of, do you need to do anything, which I'm often asked by some of my clients, do I need to do anything? The answer is no, no action specifically until retirement age, until the planning for retirement starts. And then the modelling of benefits, either early or late, because the 2008 section and the 2015 section actually offer you enhanced benefits if you work beyond 65 and state pension age. For those that do, there's a benefit in doing so. So the modelling exercise come retirement is the point at which you then take action, and that action has been influenced by the McCloud Judgment. So that concludes my very quick run through and high level review of the NHS Pension Scheme. Of course, the calculations for individuals are incredibly nuanced. So, seeking advice on an individual basis, I think, is really important. I've spoke very generally about the scheme and some of the elements within the scheme, which I hope has been useful. And I'm very happy for you to contact me, either email me or contact Louise, and for us to establish what support or service we can provide that will help you on that journey.
Thank you, Penny. So yeah, just to reiterate, I think what we want you to take away from this presentation. There's so many different nuances with pensions. Is just to give you some food for thought, and just to trigger that. Oh, I best speak to someone, because it's a real minefield out there, and we know that. You talk in your circles, and what may work for one, is completely different for what might work for another. So, just speak, as Penny said, speak with us, speak with them, and really make sure that you get the best level of advice that's going to work for you and your future. So we'll move on to some questions. So am I correct in thinking the McCloud ruling overturned the forced entry of most into the 2015 scheme? So yes, I think, as Penny said, we could talk for hours on the McCloud and what happened there, but effectively what the McCloud ruling has done has reversed the automatic entry into the 2015 scheme for everyone, basically. So as of the 1st of April 2022, no matter how old you are, you will now go into the 2015 scheme. That is automatic. So that's removed the age discrimination. So for this 7-year window from 2015 to 2022, everyone is going back into their initial scheme. So be the 95 or the 2008 scheme, you are being transitioned automatically back into those schemes by NHS Pensions. And as Penny said, when you come to retire, you make the decision as to whether that's the right thing for you. Did you want to go back into your legacy scheme, or did you want to stay in this new 2015 remedy scheme? So there is no forced entry into the 2015 scheme. That date is effectively now 2022.
Louise, can I just add something there? It's
Yes.
it's really important to think about the benefits that you'd like to take from the different sections of the scheme. Don't forget there's tax-free cash from the 1995 scheme. That might be really important to you at retirement, that you actually want that tax-free cash accrual at retirement. And for those who feel pension income's more important, then the 2015 benefits, which has a higher accrual rate, 1/54th actually, so the accrual of benefits in the 2015 scheme is much quicker than it is in the 1995 section. So I think you've ended up with the best of both worlds, hopefully, where you can really determine, what you want to choose and what's best for you and your lifestyle and your family at the end of the day when you come to retire.
Yeah, absolutely. I think this is the best decision they could have made to come out of that ruling, because one of the options was you make a decision now, which is almost impossible when you could have your whole career ahead of you, effectively. How does retirement income affect those in both the 1995 scheme and then forced into the 2015 scheme? So I wonder if is it potentially, if you've got benefits in both schemes, how would it work if you retired from the 95 but you also had benefits in the 2015?
Yes, that's right. Yeah, I understand. Yeah, I mean, that would be a hugely complex calculation, undoubtedly, but it would be a combination of benefits accrued, obviously, from the original scheme, the 95 scheme, and then benefits accrued from the 2015 scheme as well. So the opportunities to take pension income, it would be very complicated. But if, for example, you retired at 63, having accrued benefits in both of those schemes, then you would have gone beyond the normal retirement age in the 1995 benefits and accrued additional pension by having retired later than the normal retirement age in the 95 benefits, and you would have retired earlier than the normal retirement age in the 2015 section. So all of those elements would need to come into play and would then determine the final pension payable. There would also be tax-free cash built in there as well from the 1995 section. I can see a nice spreadsheet evolving here from this particular scenario, and there would be income from the 95 section, tax-free cash from the 95 section, income from the 2015 section, and the opportunity to generate greater tax-free cash from the 2015 section as well, and also any actuarial reduction on the benefits from the 2015 section because you're retiring before what could be your state pension age. So it would be a hugely complex calculation, but one that would be treated, the two sections that you've accrued would be treated individually, and then the benefits addressed with either a reduction or an enhancement, depending on what the normal retirement ages are. So complex calculation, and one where I'd like the opportunity to start planning on that one, perhaps a couple of years out of making that decision to retire.
I'm back. I do apologise for that.
Louise.
I haven't been coughing that much until now, so I think I've got it under control, but I do
Well
apologise. Thanks, Penny. Okay, next question. Am I correct in thinking that the final salary pension does not apply to GPs? Yes, it's difficult in these presentations to cover everyone and everyone.
Yeah.
Quite often we'll tailor them to whether it be hospital doctors or GPs, but retirement relates to everyone. But you are right, the GP element, as Penny alluded to earlier, is slightly different to the hospital doctors. So yours is a career averaged earnings, which is what the 2015 scheme is now for everyone. So with GPs, yes, it's effectively a cumulative position of your pensionable pay each year, and then the accrual factor is applied to your pot, and your service is also taken into account. But yes, it's you are right, there is a slight difference in how the pension is calculated.
Yeah, I mean, it's hugely complex. I think that element of the whole NHS pension scheme is the most complex. It's the doctors, GPs. They apply something called dynamisation. It's dynamised. So the contribution is determined from January to December. It's then dynamised by CPI and plus 1.5%. They're the two elements to calculate the growth on the contribution or on the fund as it's accrued each year. So it's, again, hugely complex and not a simple calculation. I mean, it's much simpler. The dynamisation figures are much easier than they used to be. I mean, CPI and 1.5 is relatively easy to build into your cash flow modelling. I mean, it used to be some convoluted calculation from the Department for Work and Pensions, but that's now become a little bit clearer and easier to understand. But yeah, it's, I think, the most complex element of the whole NHS pension scheme.
You're not wrong. You're not wrong. Which is why it's really important to have someone who understands it, because otherwise it can go horribly wrong, I think.
Yeah.
Okay, moving to the next question. In light of McCloud, should locum GPs be annualising their pension contributions or not? So yeah, this is probably slightly off early retirement topic, but yes. So with locum GPs, because you will be dipping in and out of pensionable service effectively, because you're only in pensionable service when you complete your locum A and B form, and your tier rate is based on your pensionable earnings. Now, with the 2015 scheme, along came some ridiculous rules that if you weren't in pensionable service for a full year, you had to annualise your income. So with hospital doctors, we have full-time equivalent salaries effectively. We don't have that with GPs, but now to set the tier rate, you have to annualise to work out how much income you would have earned were you in the scheme for 365 days. So yes, with the McCloud ruling, if you're going back into your legacy scheme, that rule no longer applies. Now, I wouldn't suggest you go back and start amending everything, because NHS pensions haven't yet set out there's lots of things that are going to need to be amended. You know, annual allowance calculations, tax return scheme pays, pension certificates. So there is a lot of administrative work that has to be done. That at the moment, we don't know who's doing that, because you wouldn't think that the individuals have to pay for someone to do that work, but then the professionals, you know, shouldn't really have to do it for free. So our NHS Pension's going to do it. So I think the answer to your question is no, there shouldn't be the annualisations until 2022, but how it's all going to unravel in practice, we don't know at the moment.
Yeah. There's still a lot of unanswered questions, Louise, isn't there? That's the reality. Yeah.
And that's always the way with this. There is always lots of unanswered questions, and we try and keep on top of it as much as we can and get the information out there as soon as we hear about it.
Yeah.
But that's why it's just good to come and ask us the questions effectively. Okay, I have been told by colleagues, I hear that quite a lot. My colleagues said I should do this. I've been told by colleagues that there is a best time / month to retire. Penny, is there a better time to retire?
Well, I think from no is the answer. I mean, it's such a unique thing to each individual. It's, you know, do you want to, you know, run up to Christmas and, you know, and then start the new year as you know, a retired person, or if you're tax minded, then from a tax efficiency point of view, do I want to complete my tax year and then retire in the new tax year? And there can be some advantages to that, but from a taxation of income, pensionable income, I guess, moving into, you know, if you're an additional rate taxpayer, you know, paying 45%, and then you're going to reduce to 40%, then moving into retirement in the new tax year could be advantageous, rather than spreading it across the two. I don't think so. I think it's such a unique decision and unique, you know, timing point for each individual. I think probably the taxation piece is the most objective piece of data that could influence a retirement decision. I can't think of anything else, Louise, can you, that would influence it?
I suppose the only other potential influencer is for a GP. Penny mentioned earlier about dynamisation. So
yes.
If you were thinking of retiring and you're thinking, well, do I retire on the 31st of July or the 2nd of August? I would say retire on the 2nd of August, because you'll get another month's dynamisation, for example. So you get a little bit extra in your pot for not doing anything. But otherwise, nothing that is going to materially make a difference. You know,
on a major level.
On your birthday, you know, you can retire on your 60th birthday, but no, like Penny said, everyone has such unique circumstances. There is really no right or wrong time to retire.
Yeah, there isn't. I think the slowing down, I mean, I have clients who've taken the precipice approach and worked along and taken the, right, I've retired. And I'd say on the whole, having taken a lot of clients through quite large careers, retirement planned, and then seen them into retirement and still care for them and advise them whilst now that they are retired, that the precipice approach is probably the most unsuccessful, and that the slow transition into retirement, working less, doing something different, it is, I think, the healthier one. And I see lots of clients thrive from doing that and then have time to take on board the new life and transition from what would have been a very large career to a change of pace and a change of life. It's quite a scary thought to be on 150,000, 120,000, say, one year, and that's going to reduce to 38 or 42 grand the next year. And it's what I said earlier, you know, sometimes the thought of doing these things is worse than the reality. And obviously, if you've done some planning, then the reality of that is better known. But I think that the slow transition into retirement is a good way of moving into that next phase of life.
Yeah, that's a really good point. It doesn't have to be drop off the cliff, does it?
The precipice approach, yeah.
Okay, what happens to my pension if I do not start taking it at the age of 60? I'm in the 1995 scheme.
Yeah, well, you'll continue to accrue service and you'll continue to accrue pension benefits. So it depends on how long. I mean, come the point of retirement, then that calculation again will be a very complex one, because you will have accrued benefits in that scheme and you'll be in the 2015 section as well. And there'll be a comparison needed, a compare and contrast exercise needed to see, you know, where the benefits are best placed before you then what they call crystallise and start to take, you know, benefits from the scheme. So difficult one to answer, but one to be evaluated at that, you know, that point of retirement to see what's the best decision to take come the time.
Yeah, and I think we get asked this quite a lot, and I think, you know, I suppose you have to factor up the cost in continuing to contribute potentially. I suppose, especially if you are a GP partner where you pay your employees and your employers contribution, you know, past age 60, and is it just genuinely, does it make sense for you to carry on contributing past that normal pension age? I think that's a question that we do get asked quite a lot, and sensible to model it out, isn't it? To see if it's actually
that's right.
So.
That's right. I think the pension modelling piece is really important, looking at all those variables, because of the 3 sections and the choices that you've got. I think that you know, it's quite a complex piece of work and a complex decision, you know, to be made once the objective data is in front of you, because it's always easier to make. I mean, retiring is quite an emotional thing, and having objective data to support that decision, I think, is hugely helpful. So,
yeah, definitely. If you are included in all 3 schemes, will the figures be worked out on all schemes? So yes, if you're referring to the statement that you would get in terms of the McCloud decision making, I'm presuming, yes, whatever schemes you have got benefits in and accruing in, they will all be worked out and presented to you side by side every year to aid your decision making, basically. So you will be given some information. You've obviously got to read around it and take it. They can't give you every single pro, con, plus or minus, but they will give you the basics of, this is what your pension would be if you carried on in this scheme, this is what it would be if you carried on, and this is what it would be. So yes, they will give you that for whatever scheme you are in.
Yeah, I think the point to remember there is the data that they're using to project those figures and to show those figures, you need to be confident is accurate. So I think that's the onus and responsibility is on the individual, just to make sure that the data they're using to make those calculations is correct. That's, I think, really important.
Yes, definitely. Any chance of compensation for those of us who pulled out of the pension scheme as we didn't want to be forced into the 2015 scheme? I think lots of doctors may have made decisions that have potentially they may not have had to make, whether it be because of tax charges or, you know, the 2015 scheme. Now, at the moment, we don't know, is the honest answer. And what we have sort of said is, if you feel like you have been, if you had to make a decision that you felt you were sort of compelled or, you know, forced into doing as a result of being in the 2015 scheme, then let us know. And we're trying to sort of keep a log as such, but at the moment we don't know. Like I said, there's still unknown about who he's representing.
I think it's a really incredibly important point though, Louise, because the McCloud Judgment came about by people who felt that they were being age discriminated against. And there's undoubtedly a population of NHS staff, employees and doctors and consultants who feel that they've been forced into taking action and a decision without the right advice or the full picture being presented to them. And I think that's how these judgments and rulings come about on the whole, is because they gain momentum. The group of, I'm sure, are out there, there's probably a group of doctors who've taken that action and are now perhaps regretting it. That's the reality, and thinking, why did I do that? And it was a very large tax bill that probably scared the life out of them and made them think, I need to get out of this scheme. That's the reality, isn't it, Louise? So,
it is. Yep.
Yeah.
Yep. So yes, I think I can't answer that for definite. But again, you know, as we get more information, we always try and put it out there if there happens to be some sort of compensation process. I stopped paying into the 1995 scheme 5 years ago. What has happened to my pension?
Well, it's still there. It will not disappear. It is preserved, and it will continue to accrue without obviously the contributions, but the benefits are still there, and they're still part of your history of your membership of the scheme. So, and this comes down to an understanding of the scheme, I think, in terms of what's called a funded scheme or an unfunded scheme. And the NHS Pension Scheme is an unfunded scheme. So there isn't a pot of money as such, and I'm sure most doctors and consultants understand this, but the pension contributions are used to fund those already retired on the whole, and there's no choice of fund strategy. I have some clients ask me, oh, can I invest ethically in my NHS pension fund? And of course there is no fund. So it's a defined benefit scheme. So the benefits, as it says on the tin, are defined through the scheme. And it's easier to predict pension benefits with a DB scheme. They're called DB schemes, and they are a dying scheme, to be honest. I mean, lots of banks and building societies and, well, lots of large companies had what was called defined benefit schemes. The benefits were very visible and easy to predict at retirement age, but they were incredibly expensive schemes to run. And so a defined contribution scheme is the norm now, where your contributions and your investment risk through those contributions determine potential benefits at retirement age. So the benefit or the time that you've accrued in that scheme is still there and will form part of the calculation come retirement. If you've gone from the 1995 section into the 2015 section, then come the time of retirement, both calculations will be presented and show you what you've accrued in both. So.
Yeah. And just to say, if you opt out of the scheme and you're out for longer than a year, you become a deferred member. So I think Penny mentioned earlier that your benefits, if you're a GP, accrue by this dynamisation. So it's inflation plus 1.5%. If you have opted out and you've been out for a complete tax year, you do lose that extra 1.5% yearly uplift. So it just goes up by inflation until you opt back in or you draw your benefits.
There's an interesting point there, actually. I mean, if you're out of the scheme for 2 years, then you can, if you choose to, go back into that scheme within a 2-year period. If you're out for 5 years, then you don't get the choice of going back into old scheme benefits that you may have accrued. You know, if you go and work abroad and then come back, you can't do that. You'll automatically be placed into the 2015 section. So that's definitely worth thinking about. Especially if you like the idea of tax-free cash, as part of your pension benefits, then going back into the 95 section, if you've got old accrued benefits there, having worked abroad maybe and then come back after 3.5 years, there's still the option to go back into that element. But 5 years and over, you lose that option. So just be conscious of that as well.
Yeah. And you would lose the final salary link. So if you're then the hospital doctor side and you have that 5-year break and you then go into the 2015 scheme, you lose that final salary break or lose that final salary link in your either 95 or 2008 scheme benefits.
Yeah.
So they do effectively just freeze at that point.
Yeah.
So yeah. Again, it's things to seek advice about.
Yes, to think about. That's right, and be aware of. That's right.
We've got a couple more questions. If you retired before 60, could you take the 95 pension and then freeze the 2015 to take at your state retirement age, or do you have to take both early?
Yeah, you can do that. It lets you do that. So that's, quite a good idea. Take your 95 benefits and your tax-free cash, and then don't touch the 2015 benefits until you reach the state pension age, and then draw them then, and then you won't suffer the actuarial reduction. So that's a very good strategy. I often advise clients to do anything other than take the actuarial reduction, because it's not just that reduction at that moment in time, it's a reduction for the rest of your retired life. And again, when you look at the cash flow model of the impact of loss of income from an actuarial reduction until your predicted morbidity age, then it's quite scary numbers, and it can help to make those sorts of decisions. And I've had clients who've gone and done some very alternative work rather than take benefits early and suffer the reduction. So I think that's a good strategy. But if you can plan to do that, it's an ideal model, I know, and it doesn't work for everyone, but it's a good strategy and worth building into a plan.
Yeah, definitely. What happens to historical annual allowance charges from the 2015 scheme if I select go back into the 95 scheme at retirement? So what's going to happen, because at the moment they're transitioning, so from the McCloud Judgment, they're transitioning everyone back to their legacy scheme, so the 95 or the 2008 scheme. So any pension growth will have to be recalculated because they have different accrual rates. As Penny said, the 2015 scheme is a more generous accrual rate. So people did have larger annual allowance charges, or they have larger pension growth in the 2015 scheme than they probably did in the 95 or 2008 scheme. So in this 7-year window, they will all have to be recalculated. Now, if when you come to retire, you say, well, that was the right decision for me, I wanted to stay in the 95 or the 2008 scheme, they've obviously already been recalculated. If you do a refund, you'll get the tax back, or if you've done a scheme pays, you can amend the scheme pays so you're not disadvantaged.
Yeah.
As I understand it, if you choose to go into the 2015 scheme when you retire, and therefore your annual allowance has to be reworked again, and you're worse off because of the annual allowance, I don't believe you will be penalised for that. That is my understanding. So annual allowance should not really play too much of a factor in your decision making. That's how I understand the annual allowance side of things to work.
I think I might try and find out a little bit more information on that and see if I can find because I agree with you, Louise. That's my understanding.
Sorry, Penny.
Say again.
I said it is in the consultation application, but again, I will have a little look, and but I'm pretty sure that is the you won't, because I had to read it a couple of times. So you won't be disadvantaged if you choose when you retire and you've got a higher annual allowance charge based on your decision at that point. You won't be penalised for it. That's our understanding. That's my understanding.
Yeah.
So if you stop working but don't draw your pension till age 60, am I correct in thinking it's wise to do a little work so you're still contributing to your pension, and therefore you're earning the higher percentage of interest on your pension pot? So if you stop working but don't draw your pension, should you do a little work, so whether, like I guess what you're saying, reduce your hours down so you're still contributing, just to keep that pot ticking over.
Yeah, I mean, that is an interesting exercise, actually. Reducing hours can often have a very, very little impact on pension benefits in the 1995 section, actually. I'm assuming you're, and you must tell me if I'm wrong, that you continue to work in the NHS, albeit on a much lesser scale and for less time, and you continue to work, continue to contribute based on your reduced salary, and the service history is obviously on a reduced basis as well because you're working less. So yeah, that's another way of continuing to accrue benefits in the scheme and hopefully changing your life, having an easier transition into retirement. So yeah, that can be a very good way of making that transition, not taking a precipice approach, but making that transition into retirement and working less. And I think planning equipping yourself with the data that shows you the impact of doing that before you make the decision to do it. And that's a workable model that we can do. And then you'll make that decision on an informed basis. So it's so individual and so unique to the individual as to how you want to approach retirement. Some people are highly unmotivated to do anything more and feel that they need that break, but it's worth taking a breath and just talking through that strategy with someone, either the accountant or an advisor with some knowledge of the scheme, and then planning out and modelling what that looks like, if you were to do that, and the impact of that on the benefits come the time. You may think that you could do that for a couple of years and then take benefits, and modelling that and looking at that data is a useful exercise.
How does working part-time affect GP pension contributions? So if you are a GP and you work part-time, so your tier rates are based on your actual income. They're not whole-time equivalent for these purposes. No. So if you are earning less, your tier rate will be lower, so you will pay lower contributions, but your pot will be going up at a lower rate. So it's all very much relative. If you are a hospital doctor, it's done on a whole-time equivalent basis. So your contributions won't really be affected if you are part-time, but for a GP, they will be reduced down. Is it okay to continue working past your normal retirement age because you have a short service history?
Yes, absolutely. Absolutely. If you're motivated to do so. And of course, I would have thought that there's huge momentum for doctors not to retire early and to work beyond retirement age if they feel happy to do so and have the motivation to do so. So yes, if your service record is very short within the NHS Pension Scheme, and again, model it through and see what it looks like. Just by working another couple of years, what benefits will you accrue into the pension if you were to do so? And that will help you in your decision making as well before taking on that extra work for another couple of years.
Yeah, fab. Okay. If you retire before state pension age and draw your pension, should you continue to pay national insurance until your state pension age?
Yeah, you can. It feels like there's a couple of questions in there. It might be that you haven't accrued enough NI to achieve the full state pension, and if you feel that you haven't, then there's an opportunity to. I mean, the government website for predicted state pension is hugely useful, and you can identify whether you have any missing NI contributions, and then you can add to them and see how that will influence your state pension. Or I may have interpreted the question slightly differently. Is there an opportunity to take the pension and then make the additional NI contributions to make up any state pension reduction? I mean, there is. I mean, I'll keep it simple. There is an opportunity to do that, to add a lump sum, make an extra contribution to achieve full state pension benefits at state pension age.
Yeah, definitely. All right, so I think that is it. We have made our way through all of the questions. So I'd just like to say thank you for everyone listening. I hope it's been useful. As I said, you will be sent the link to watch the recording. Please fill out the feedback, and if you have any other questions, please do get in touch with myself or with Penny. Penny, thank you very much for
my pleasure.
giving us,
good questions.
Yes, great question. We always get some really good questions whenever we put on pension talks, and I think it's really nice to have a financial advisor to bounce those questions off and get it from both sides.
Yeah, I hope that's been helpful.
So yeah, thank you everyone very much, and we look forward to putting on another one with you all soon. Thank you.